The main rule of gap trading is to wait for a strong signal first before you open a trade. In this video, I will share with you a step-by-step guide for trading gaps. You will learn a profitable gap trading strategy for trading any forex pair and a lot of useful gap trading tips. And as a bonus, I will share a fragment of a live stream with my students where we spotted and created a gap. Like this video, subscribe to my YouTube channel, and let's start. First, let's start with the essential theory, and let me explain to you how to analyze the gaps and how to use them for trading. On this price chart, we have a great example of a huge gap up. Once you identify that, you should always remember that with a very high probability, the gap is going to be filled. There is a high chance that after formation of the gap, at some moment the price will drop and the price will return to the level of the gap opening. The first thing that you need to do after you spotted the gap, you will need to identify a gap opening level. In our example, our gap opening level is going to be right here. That was the exact level where this red candlestick closed and then this gap up was formed. So we will see that this gap is filled when the price returns to this gap opening level. The main problem, however, is that after formation of the gap, the market may go way higher before it fills the gap. And before you open a trade, you will need to wait a strong confirmation signal. And here you will need to learn an important rule. After formation of a gap up, the market will seek a liquidity. The formation of the gap is caused by a huge buying imbalance, the excess of the market demand. That excess of demand needs to be absorbed, and it will be absorbed when the price reaches a significant supply zone, a significant liquidity zone. So after formation of the gap and after the identification of a gap opening level, the next step will be to identify a significant closest liquidity zone. We zoom out the chart and we analyze the historic price action, and we look left, looking for our closest strong liquidity zone. And here is our zone. Here's our significant liquidity cluster, significant historic resistance that the market respected in the past. So our task will be to wait for a test of that liquidity zone. And you can see that our liquidity zone was successfully tested. We will assume that within that supply area, sellers are placing their selling orders. And the excess of the market demand that made the market form this gap will be absorbed after a test of that supply zone. But we will not sell blindly from that supply zone. After we see its test, our next task will be to wait for a confirmation signal. After a test of a supply zone, we need to a price action within that and look for a clear sign of strength of the sellers. The signal that you should look for is a bearish price action or candlestick pattern. In our example, we can see that the price formed a tiny double top pattern, and the price also formed a bearish engulfing candle. A violation of a neckline of this pattern gives us a strong bearish confirmation. Why we need that? Because as I said, after formation of a gap up, the market may go way higher, and even a test of a supply zone sometimes is not enough to stop the buyers. So we need a strong bearish price action or candlestick confirmation to confirm that sellers finally started to push strongly. After you identified a strong bearish confirmation, sell the market immediately. For example, here you could sell after a close of this bearish engulfing candle. Here could be your entry for this trade. Stop loss should lie strictly above the highs, and your take profit level is the gap opening level. Once you open the trade, get ready to wait. In this example, it took more than 30 hours before pound yen pair finally dropped to the target. Look at the huge gap up that I spotted on Aussie yen pair analyzing a 4-hour time frame. After the price formed this gap, you can see that the price went way higher. To trade that gap correctly, first we will need to find our gap opening level. Our gap opening level is right here, and we can make a prediction that Aussie yen will drop to that price level. Then we will need to identify our closest strong liquidity zone. Analyzing a historic price action, we can see our supply zone right here. You can see that after formation of the gap, the price reached that, and we even got a bullish trap above that. After we see our strong liquidity zone and after we see its test, we will need to look for a sign of strength of the sellers. We will need to wait for a strong bearish confirmation. In this case, we have a very strong bearish price action pattern. You can see that after the price tested our supply zone, the price formed a head and shoulders pattern. That is a very cute bearish pattern that the price formed. You can see that then neckline of the pattern was broken with the high momentum bearish candle. That is our strong confirmation. That is a clear sign of strength of the sellers. So we can sell. The problem is though that if we sell from here after a close of this high momentum bearish candle and set our stop loss according to the rules, with the target being our gap opening level, you can see that we are going to have a negative reward to risk ratio, meaning that we will win less than we will potentially lose. If you see a picture like that, always remember that you can trade on a retest of a broken neckline. The broken neckline will provide a very safe zone to sell the market from, and it will provide a way better reward to risk ratio. So for me, a good reward to risk ratio is 1.5. So based on that, I look for the entry for my trade. So I will look for a retest of that level. I will sell from here and I will expect a bearish movement to our gap opening level. That is how easily we built a trading plan for trading any gap. And now let me show you how we traded gap on the live stream with my students. We have a very significant liquidity zone right here, and this zone is truly critical for the pair. And analyzing a historic price action, we can see that many times in the past it was a strong support, it was a strong resistance, market demand concentrated within that zone, market supply concentrated within that zone. And what happened with the pair on Friday? The pair violated that zone. It was a strong support, and we assume that after a breakout, it turned into a strong resistance, the zone from where we can anticipate a bearish continuation. Then let's examine an intraday price action. On a 4-hour time frame, we can see that we got a nice gap up opening, meaning that the price formed a gap immediately after the market opened today. And what we know about such kind of gaps is that with the high probability, gap up opening is going to be filled. One more thing that I wanted to show you analyzing a 4-hour time frame is that on a 4-hour time frame we have this strong trend line, a strong intraday trend line that was respected 3 times already. And I see a very nice confluence here, a confluence that is based on this falling trend line and this horizontal resistance. So the price tested that significant supply area. You can see that the market stopped growing. On an hourly time frame, I spotted a very strong bearish confirmation. Here in an hourly time frame, the price formed a double top pattern. Double top pattern, and its neckline was violated during the Asian session today. And we can see that the market retested broken neckline then, and from a broken neckline, I sold the pair. Because here's how we treat gap up openings. After we spot a gap up opening, the next thing that we look for is the so-called sign of strength of the sellers, because after the formation of the gap, the price may easily go higher. So we are strictly looking for sign of strength of the sellers, a bearish confirmation before we open a short position. And this double top pattern that I spotted on an hourly time frame provides a strong bearish confirmation. So I took a short trade on a retest of a broken neckline right here, set stop loss above the highs of the pattern, and with that trade I am aiming at a gap opening level. Yes, here's our gap opening level, and take profit is lying a couple of pips above that. So that is the active trade that we have on the Canadian pair. We see a retest of our supply zone. You can see that it was retested with the New York session opening. We tested that zone, its lower boundary, and formed a peculiar doji candle on that. Let's hope that the market will continue falling, and fingers are crossed. And you can see that after 20 hours of waiting, the price finally dropped and the market filled the gap, almost 50 pips of profit for me, and you can see that the market dropped way lower then. Next time when you spot the gap, remember that gaps always provide profitable trading opportunities. Use this simple strategy to trade them, and good luck to you in trading Forex. Join my trading academy and watch how I trade live. Also traders, please don't forget to watch my other videos.